This is the second video in a two-part series on money and the central banks. Here we are going to look at demand and supply, the Fisher effect, inflation, and sovereign solvency. Let's start by looking at the various types of demand and supply of money. First, we have transactions demand, which is a demand for money which people need to buy goods and services. This demand for money increases when the economy is expanding and GDP is rising. Next, we have precautionary demand, which is money that people want to hold for any unknown future needs. For very large companies, there will be a more significant need for this kind of money. Just the same as with transaction demand, this also rises alongside GDP. Finally, then we have speculative demand. This demand for money is higher when current investment returns are lower, and there is an expectation that future returns will be higher. When current investment returns are high, this demand will be low because people will already have their money invested and won't be interested in holding cash balances. This graph shows us the balance in terms of money supply and money demand. The supply level is set by monetary policy determined by the central bank. When interest rates are too high, companies and individuals are holding more cash than they want to. They see the opportunity cost in continuing to hold that cash. So they will go out and spend their money on interest-bearing securities, and as a result, interest rates will fall. On the other hand, when rates are too low, securities are sold to get access to that cash. Now, because the opportunity cost of holding cash is much lower, there is a higher demand for it. Once enough securities are sold, the interest rate will move back up. Okay, next we're going to look at the Fisher effect. The Fisher effect is a relation to help us understand the components of the riskless nominal interest rate. What we are saying here is that the nominal rate of interest, for example, the rate on a US Treasury bill, is made up of the real rate, the expected inflation, and a premium for uncertainty regarding inflation. What this shows is that real rates are in fact actually relatively stable, and the majority of the change in interest rates comes from inflation and the uncertainty with regard to inflation. The next thing we are going to look at is the costs of expected and unexpected inflation. Expected inflation is a fairly simple concept involving increases to the cost of holding money. If we expect inflation at a certain level, then we know the opportunity cost of holding money and what the decrease in the purchasing power of our money will be. Now, on the other hand, the cost associated with unexpected inflation is a little more complex. There are two major points to note here. Firstly, unexpected inflation moves wealth from lenders to borrowers. Imagine I borrow €250,000 today, and with 50 grand of my own, I buy a house for €300,000. As per the terms of the loan, I have a fixed payment of about €1,200 a month for the next 30 years. Because of inflation, the purchasing power of that fixed €1,200 repayment is going down. Even though the bank is always going to be receiving €1,200, the value to them of that €1,200 is falling as time passes. At the same time, also because of inflation, the market value of the house I bought has increased from the €300,000 purchase price to a current value of €500,000. So as inflation reduces the value of the fixed amount the bank is taking from me in mortgage repayments, it is simultaneously increasing the value of the house I bought. So there is a transfer of wealth from lender to borrower. When inflation is volatile and the amount of this inequality is harder to determine, lenders will look for higher rates to compensate them for this uncertainty. The second effect of unexpected inflation is that the reliability of supply and demand information can be lessened. As a producer of a product, we need to know the difference between inflation and demand growth for our product. Let's say that over the course of a year, the price of our product has risen from €10 to €12. The company will want to know what has caused the price increase and why it has not resulted in a drop in demand. There are two possible causes of a price increase. Number one is inflation. The general economy is causing a price increase across the board, and our product is rising naturally with the economy. That means that this company is happily trading as it stands, and we shouldn't make any changes to supply. The second possibility is that consumers are demanding more of our product. And because of the increased demand, we are able to charge a higher price. If we are able to charge a higher price, then we should expand and we should increase supply. The problem is that if we assume a price increase is due to consumers demanding more of our product, when in fact inflation is the cause, then by expanding production, we will oversupply the market and eat into our own profits. Finally, then we will quickly look at national debt relative to GDP. The first thing you want to think about here is solvency. When an economy runs a fiscal deficit, they are spending more money than they are taking in income. So they are incurring interest payments. When debt levels increase and ratios of debt to GDP increase, the solvency of the country becomes an issue. The ratio we are talking about here is the debt ratio, aggregate debt to GDP. How this ratio behaves over time will be a direct consequence of the relationship between growth in GDP and the interest level on aggregate debt. So what are the reasons we should be concerned about a rising debt ratio? Well, if we have consistently higher fiscal deficits, then we are going to need to continuously raise taxes to maintain solvency. Rising tax levels diminish the incentive to earn income and slows economic development in the long run. Also, we have the crowding out effect. This is a market phenomenon by which government's borrowing causes interest rates to rise such that businesses can no longer get access to cheap funding for their own projects. Effectively, the government's spending and borrowing policy pushes businesses out of their country. Now, on the other hand, we have a number of arguments which say that we should not be concerned about the size of fiscal debt. First, the aggregate debt level may overstate the problem. If the majority of debt is held privately by individuals, then the rising debt ratio is not a result of government borrowing to fund national spending, so it's not a cause for concern about sovereign solvency. The next argument says that if we are using debt to fund capital projects, then the future returns from those projects will enhance the government's ability to repay. So in this case, the potential for insolvency is a short-run and temporary imbalance, which will smooth out over time. The final point is that if we are running a fiscal deficit, the time may have come for a necessary reform in the taxation policy of government. Reform in this instance obviously will not involve a simple tax hike, or the first concern about fiscal debt would apply. It would have to be a more comprehensive re-evaluation of the economy and how incomes are earned.